developing market, and I think we all appreciate there's been a lot of talk globally, domestically about renewable energy and so on and so forth. And Nedbank, obviously, in line with our values, our aspirations, strongly support the green, the renewable, the sustainable, and in light of that, we have managed to secure an opportunity, along with the growth in investor mandates, who are looking for green investments, to realise a bond that's going to bring to the market shortly.
Sure.
It's going to be a R5 billion bond, so a significant size, and essentially the core of this money will be used to finance renewable energy projects,
right,
and green projects. I think the trick here is to understand what green is when we talk about a green bond. So the application or uses of the funds that are raised will be in green projects, renewable projects, eco-friendly projects, and of course the uses have to match up to the respective mandates that investors have.
Yeah, correct me if I'm wrong, but this is the first of its kind, is it?
It is indeed, yes.
And so what kind of pricing have you seen from the market? Are you likely to, or do you anticipate? The
pricing that we are expecting is going to be unique to start with, in that there hasn't been one of this nature done previously. Having said that, because it's got this unique aura to it of being the first of its kind, and there is very little of it currently available, so those investors with mandates that have capacity, that have put funds aside to invest in green bonds, don't have much choice. So we're expecting the pricing to be very competitive relative to senior unsecured.
Now, I would imagine by now you'd have done some kind of road shows to try and gauge the kind of appetite that there is for it. What
Indeed.
have you seen?
It's a market in its infancy. I think, just off the bat, there's no real commercial gain to be had from green bonds. And of course, if you're looking at dynamically managed asset funds, then of course it's got to rank sort of equally with other commercial paper or other long-term bonds. Having said that, there are specific mandates that do believe in the sustainability ideal and would be looking specifically for green-related uses for the cash, and to that end, and having a shortage of assets, we find the pricing can be pretty competitive.
Yeah, you're coming into a market, of course, that you mentioned yourself at the conference this morning that has a very low allocation for fixed income.
Indeed.
So in terms of the fit between that bond and overall bringing up the level of fixed income assets into your overall portfolio, how do you see that fitting in?
Green bonds are still far too small to make any impact.
A big difference.
When we're talking about asset allocation in the broader sense, if you look at South Africa has just over 4 trillion rands worth of assets under management, and that covers equity, property, fixed income and the like. Equity being north of 50%, fixed income being substantially less than that, and having decreased in the last 10 years from somewhere around about, I think it was 33% to about 24%. So we are, as a country, underweight fixed income generally. One would anticipate that this might change depending entirely on the outlook in global markets. And if you're looking at capital protection, fixed income does look attractive, and green bonds would fit into that.
Why is that the case, Bruce? Particularly, is it because equities have outperformed fixed income, or in fact it's just the ignorance that we're talking about here? Very
difficult to specify one or the other. Bearing in mind that South Africans have had a love affair with equities forever and ever.
Sure. Because equities have performed.
Absolutely. And that's not to say that the bond market doesn't have its periods where it's performed. And I think in the last 4 or 5 years, it has performed relatively well. With interest rates moving down, capital appreciation and so on and so forth. The question is, what happens going forward? And what are the dynamics driving investment thinking? Certainly one senses that maybe the trend going forward in terms of economic markets would be capital preservation, to which extent you might look to fixed income,
particularly in this environment,
as a better bet as opposed to equity, particularly domestic equities. But we can talk about this forever and ever.
Indeed. But in terms of therefore the growth potential for fixed income to become a larger part in your overall portfolio, surely given the low level now, we're looking at huge opportunity here.
Correct. There is capacity. There's capacity and opportunity for the fixed income markets to grow significantly.
Sure.
If I look just at Australia, for example, their corporate bond market is probably in excess of 50% of their listed debt market. In South Africa, it's substantially less than that. And if I drill down even further, you know, I mentioned earlier that there was 1.3 trillion of bonds listed on the Johannesburg Stock Exchange. 14% of that is in the banking sector, and just less than 7% is in the corporate sector, specifically in the corporate sector, which is really low. You know, one's got to understand that. So that has capacity to grow, but at the same time, we need economic growth to encourage borrowing, to encourage spending, capital structure, infrastructure spend, etc., etc.
Yeah, but in your view, why do we have such a low corporate debt issuance?
We're a conservative country. We don't like to be highly geared, and I think that just goes to the nature of the management within the country and the general psyche. Having said that, there's more an appreciation and a shareholder activism that is coming to the fore that will say we need to sweat our balance sheets some more. We need more gearing, we need more debt, interest deductible debt on our balance sheets to produce a better return on capital. And yeah, I think it's a process. So that will happen over time.
So when you look at the corporate environment, then do you see that awakening coming in and sort of, what's the potential there for corporates to issue more debt going forward? Told you 2011 and 2012.
The potential is huge. Put it this way, it's a really good time to be raising capital if you're a borrower.
Right.
Interest rates are pretty much close to their historical lows. We've got asset swap anomalies which can benefit any floating rate borrower and switch it into fixed, so you can fix rates at relatively low rates. There is a shortage of assets out there, so there's good competition and spread compression from asset managers who participate in auctions. So from a financing cost point of view, the appetite's there, the capacity's there, the pricing's there. It's all about the actual borrowers themselves. What am I going to use the money for, and where am I going to apply it in terms, and I suppose in a market that where the economic outlook is fairly pedestrian.
Yeah. Now, one of the issues that was raised in the morning was that we have regulation that's sort of, if you like, putting a spanner in the works, because you have the Companies Act, which some argued in the morning does not really encourage corporates to come and issue bonds because of the definition of some of the foreign companies that are privately owned here in South Africa. And also someone spoke about the issue of the new listings rules for the JSE. What kind of an impact do you see those having?
It's been a pretty interesting year and fairly volatile, just from a domestic point of view, and the fact that we've had 3 sets of independent legislation and regulations coming to being or promulgated this year. The first being the new Companies Act, and we'll speak about that in a moment. At the same time, we've had the new debt listing requirements as issued by the Johannesburg Stock Exchange, and in addition to which we've got the Security Services Act, which is getting changed into the Financial Markets Bill as of the 1st of January 2012. So there are unintended consequences of the interaction between these 3 pieces of legislation. I think probably the most significant one for the debt capital markets would be that relating to the change in the MOI and the definition of securities in the MOI and the Companies Act, which now the definition of securities goes to include all debentures, bonds, etc., whereas in the previous act it was only referring to equities. And what it states is that basically a private company cannot have transferable assets on its balance sheet.
Right.
So as soon as you now include bonds and debentures, and according to the JSE debt listing requirements, those need to be transferable. So you can't, as a private company with a parent company offshore, have JSE listed debt on your balance sheet without stepping up your disclosure to the level of a public company, which now there's a conflict, and a lot of them don't want to have that level of disclosure. How do you remain a public company? Right now, there's this huge amount of uncertainty as to which way to go, and will there be a solution to this ultimately, which will allow private companies to have transferable assets on their balance sheets and not conflict with the Companies Act, and satisfy the JSE debt listing requirements at the same time. So an interesting time.